So you're thinking about starting investing for dividends and cash flow in 2018, or you have an existing portfolio and you're looking to take it to the next level, but you might be a little bit skeptical, you might be a little bit concerned about losing money, about losing principal, because the stock market is at all-time highs. The stock market has gone up quite a bit. And so I want to discuss this very question today. I've been receiving this question from many different subscribers on my channel here on PPC Ian YouTube channel. I'm an investor. I invest for dividends and cash flow. I've been at this for over 20 years. And so I want to discuss the topic of starting out with dividend growth investing in 2018. Hey everyone, this is Ian from ppcian.com. Earlier today, I swam 3,000 yards. This was a new milestone for me, a new record, and it actually took about an hour to accomplish this. It was non-stop, all freestyle, did not stop at all, just kept going. And I really like endurance sports, and swimming and running in particular. I love these sports because they share many parallels to my investing style, which is investing for dividends and cash flow. And so I think that this analogy between swimming and dividend growth investing is especially important today because I am receiving so many questions from subscribers about starting in 2018. I get questions like, hey Ian, I am terrified of losing money. I am terrified of getting started at the absolute top of the stock market and seeing my hard-earned money, my hard-earned savings disappear. Ian, I am concerned about that. I'm thinking about waiting. I don't think I should be starting here in 2018. And so I cannot answer this question for folks out there. I can only speak from my own experience. But what I want to do today is present some thoughts. I want to present some frameworks that I think anyone who is thinking about getting started in 2018, or maybe has an existing portfolio but is thinking about taking it to the next level, I think that these frameworks may help out. And so let's take the swimming analogy to start out with. Basically, with swimming, 3,000 yards, pretty big deal, takes about an hour. The first 500 to 1,000 yards, it's the hardest by far. Your muscles are just getting adapted to what's going on. You kind of feel some fatigue right off the bat, and you start wondering, especially if you're not skilled or used to swimming for a long distance, you start thinking, am I going to make it? Am I going to reach my goal? And thankfully, I've been through this many times, so I knew what was going to happen. What happens is between 500 and 1,000 yards, especially once I'm past 1,000, everything gets easier. I just start coasting. It's, I would say, probably just that the endorphins kicking in. It's just like running. When one starts running, it's hard at the beginning, gets easier. Same with swimming. And so for the second 1,000 yards, a lot easier. For the third 1,000 yards, relatively easy. And quite frankly, I could have kept going on even more. But that being said, I wanted to not overexert myself as well. And so the point here is that when anyone gets started with dividend investing, anyone gets started with financial freedom, that first 500 to 1,000 yards of that marathon or that race, it's going to be difficult. There's going to be some trial and error. There's going to be some triumphs and successes. There's going to be some mistakes. And the purpose of my channel is to hopefully help folks out there minimize mistakes and to learn from my personal experience. But that being said, everyone is going to have to learn in their own way. And so the point I am making is if one is thinking about financial freedom, one wants to invest in dividends for passive income and cash flow, in my opinion, my humble opinion, there is no better time to get started than now, because the sooner one starts, the sooner one can make mistakes and the sooner one can learn from those mistakes and evolve. If one pushes this out, it's just pushing out the inevitable. It's pushing out those mistakes. So another thing about dividend growth investing that's very similar to swimming is I had to pace myself. Did I go all out in my first 1,000 yards as fast as I could? No, I paced myself the entire thing. And quite frankly, even by the end, maybe I could have pushed myself harder, but I didn't because I want to have strength to go back and do this again. And dividend investing is the same thing. It is all about averaging in to stocks over time. What does averaging in mean? It means basically that I don't put 100% of all the money I'm ever going to invest in the stock market now and just set it and forget it. What it means is I'm going to allocate a certain amount of money each month, usually a percentage of my paycheck, of my salary, that I will invest month after month after month. And so the fact of the matter is just like swimming, this is an endurance sport. It's about longevity. It's about averaging in over time. And we'll get more to this concept later because I want to share something just incredibly helpful, in my opinion at least, another framework that I think everyone is going to really like. But basically, just to set the stage, dividend investing is about that endurance. And so if one is going to start a race, they're not just going to put all of their money or all of their capital in and set it and forget it, and they're going to average in over time. And so, and quite frankly, the goal of most or many dividend investors, myself included, is to live off of dividends, live off of all the passive income and cash flow, and live a really nice lifestyle. And so to reach that goal, a lot of capital has to be invested, and it takes a lot of time to earn that capital and to invest the capital in the stock market. And so the point being is, most people watching this channel, if they're thinking about just putting in the money, setting and forgetting, it's just not going to be enough. This will work for some people who have already achieved extreme success in their life financially, but for most people out there, this is going to be a journey. It's going to take years, if not decades, of averaging in. And so the fact of the matter is, this isn't a set it and forget it strategy. This is a strategy about the long term. And so when you're thinking that far out, it's all about, in my opinion, getting started sooner than later. So I want to actually transition to this chart here. I think this chart is incredibly fundamental to the very question that I'm being asked about, hey Ian, should I start now or wait? And look, I can't answer the question for folks out there, but what I can do is answer if I were starting again. And even in my current situation, am I buying or not? I'm buying right now. I'm always buying. Up market, down market, I am averaging in to stocks, because it's going to take me a long time to get where I need to go to amass the kind of passive income that I want. And so this is very interesting. Here is hypothetically 2018 right here. Market's been going up for a while. A lot of people who are just getting into things right now might be thinking a little bit of regret or a little bit of unhappiness that they missed out on this bull market run. If I just started back here, my goodness, I would have seen all of these gains. But the fact of the matter is, just addressing that point, as dividend investors, a lot of capital has to get deployed. And that capital is going to be deployed over time. And so, yeah, maybe one missed out on these gains, but that being said, in the scheme of things, especially if one's just averaging in a little each month, is it really that big of a loss? Is it really that big of a miss? Probably not for most people, because again, this is about the long term. This is about averaging in for a very long time. But anyways, someone's sitting here and they're thinking, hey, maybe the market's going to go up a little bit more. Maybe it's not. Sometime in the next few years, it's going to correct. And it's going to correct aggressively, hypothetically saying. And this could very well happen. And so people are concerned. And so that's a very, very well a possibility that it could correct, it could be down, it could be a bear market for a while, and then finally it could resume its upward ascendancy. So that's like scenario one. Let's look though at another scenario. Let's just say the same hypothetical investor just waits. Like, hey, I think the market's going to correct. I don't want to get in now. I'm just going to completely wait. I am terrified of losing capital. Well, this investor, let's say 2025 is the trough of the bear market. It starts recovering at that point up to new highs that we could have never even imagined. Okay, that's scenario two. The investor starts there. Which scenario do I like better? Which one, and you should think about this at home as a thought exercise. Which scenario would you prefer? Personally, I prefer the first scenario, and I'll tell you why. Scenario one, let's say I start here. Yes, on capital invested in those early years, I am, quote unquote, losing money, or I'm losing my principal. That being said, knowing that I am saving a certain percentage of my paycheck each month, knowing that I am averaging in each month into world-class stocks, knowing that I have a long way to go to get where I need to be, this provides, scenario one, more time because I'm averaging all the way down. I progressively get lower prices. In dividend growth investing, when a stock goes down, the yield goes up, the starting yield. It is always better for a dividend investor, in my opinion, to be buying when stocks are going down because it's exciting to see progressively better yields. And so if I'm investing a percentage of my paycheck all the way down, I'm getting all of that extra time that the second investor just doesn't have. This investor has less time. And so in scenario one, I'm averaging it down. I'm buying in all of the trough of the bear market. And then I'm averaging up as it goes to new highs. And so I've got all of this time. And let's say out here, maybe it's like 2030 or so, it hits completely new highs, like way up into the right. Investor one got the benefit of all of these years of averaging, whereas investor two started in 2025. They're buying all the way up, so they got some benefit of the trough of the market. They have some benefit of averaging up before it hits the peak again and it hits new highs. But investor two misses out. They have less time to average in when prices are relatively low, because it's all relative, because one day prices will probably surpass the peak. Prices will hit new all-time highs. And so investor one, yeah, they have to suffer in the first few years, maybe mentally, maybe worrying that they lost principal. But that being said, they have more time to average in. And so that's an important framework. Another framework I want to share with everyone today is something that just helps me as a dividend investor. And what that is it's this idea of not worrying about principal. I invest for dividends and cash flow. I invest for dividend checks that can pay bills, that increase over time. I reinvest the dividends so that they compound quicker. One day I will not do that because I will live off the dividends. But the fact of the matter is yeah, my ego takes a hit if my principal goes down. And yeah, my ego gets a pat on the back when the principal goes up. I see capital appreciation. I've even done videos about this, how I tend to beat the S&P 500. I have a history of doing this. Yeah, that's cool and it's fun. But I cannot pay the bills with capital appreciation. And at the end of the day, one thing that has helped me, one framework that has always helped me, is basically as soon as I buy a stock, just not even looking at principal, not even worrying about did I make money, did I lose money. I'm just assuming, hey, I lost it all, it's gone. And of course I only invest money that I don't need to pay for things right away. And so by doing that, it helps me focus. It helps me focus on dividends. So I track the dividends, I watch the dividends grow, I see a growing stream of dividends, and the best companies, markets up, markets down, they're going to keep increasing the dividend. And so the point here is if one wants to be a dividend investor, I think this is one of the greatest kinds of investors that one could be, because one is not tied to these fluctuations in the market. One doesn't have to worry as much, oh no, did I lose capital? Because the fact of the matter is even if one loses capital, loses the principal, eventually it'll come back. And during all this time, the dividend stream is growing. Dividends are growing. And the sooner one starts, the sooner one receives their first dividend check. The sooner one can reinvest that dividend, the sooner the snowball starts compounding. And so that's been something that has always helped me in an up market, in a down market, is just saying, hey, Ian, yeah, it's kind of unfortunate that you lost some capital, but you know what? Who cares? You're in this for the dividends. And quite frankly, if you lose some capital, it means you're going to be able to average in at even better prices. And so quite frankly, I actually hope at some point for a somewhat of a downturn so I can get better values, because the better values that are in the market, the quicker I can reach my financial freedom goals. So let me look at my notebook. I think I jotted down one or two other things today. So here's the one thing I want to leave everyone with. 2018 is a lot different than when I got started. I've been in this for over 20 years. For most of these 20 years, even up to the present, I have a strategy of going all in. I don't really have an emergency fund. I don't really save money for emergency. I've just been like, hey, Ian, I want to reach financial freedom as quickly as possible. I'm just going all in. Now that we're in 2018, especially if you've been watching my videos, I have a New Year's resolutions one. I'll link to it in the description below. I've started hinting that I want to slowly build up an emergency fund. And so in my particular situation, it makes sense to have an emergency fund right now as my family is growing. It makes sense to have an emergency fund because the portfolio has hit a certain size. I've been able to take some risk by going all in and it's paid off. And quite frankly, the market is near all-time highs, or it's at all-time highs. Will it keep going? I don't know. So for me, I continue to average in, but I'm also slowly, very slowly, building an emergency fund. And so if someone is really, really concerned about starting dividend growth investing these days, one way to look at things is, well, hey, maybe in addition to starting, it makes sense to also create an emergency fund at the same time. Whereas if we're down here, time is of the essence. Maybe it does not make sense to create an emergency fund. Maybe it does. Everyone is different. But in my case, whenever the market is like this, emergency fund is usually not the thing on my mind. And so I hope this video is helpful. Certainly, dividend growth investing may not be for everyone. I think within the world of investing, it's one of the more conservative strategies. But if one is completely terrified of losing money and they're going to lose sleep over it, I don't know. I can't really answer that particular question. Maybe dividend investing is for them, maybe it is not. But what I wanted to do today is just share some frameworks, some ways of thinking about dividends that have influenced my own portfolio, my own strategy over the years. These may be helpful, they may not. I imagine some of these frameworks at least are helpful to folks starting out right now or considering building their portfolio in this present market that has gone up quite a bit. So I want to thank all of you for watching. It really means the world to me. PPCE and YouTube channel is now over 2,000 subscribers. So we are making some progress here. Just a great community. I'm getting so many great questions. I try to respond to all of them. Sometimes it's difficult. I do my best. I really appreciate the questions. I thank you for the questions. Please keep them coming because quite frankly, they also fuel the video content. And this video is because of the great questions. Also, if you enjoyed the video today, one way that you can personally help me out is just giving a thumbs up to the video, liking it, or subscribing to my channel or leaving a comment. All of that, it really helps me out, and it's a great way that you can thank me, and it helps support my channel here on YouTube. I do want to continue to grow this channel, and certainly within 2018, I'm hoping to hit 10,000 subscribers by the end of the year, so we'll see if I can get there or not. But just like in personal finance, with this YouTube channel, I want to stretch myself and see how close I can get. It'll be interesting. So before we leave today, just a friendly disclaimer: I am not a licensed investment advisor. In today's video, it is not investment advice. Today's video is just for your fun and entertainment. If you are going to go out and invest in the stock market or anywhere else, please do consult a licensed financial advisor first. Thank you so much for watching. I will see you in the next PPCE and dividend investing video.